Good afternoon, everybody. Thanks for joining us on what is a short and sweltering week here in Canada. We're delighted to have Benny Tal with us today to shed a little bit of light on the economy and the Canadian housing market, which again is back into our national discussions as we all fret about the affordability of housing. So having his insights will be super helpful for us today. Before we get started, I'm going to hand it to Sandra Shep, and she's going to give us a little bit of the logistics of how we'll work through and get questions asked and answered. Sandra?
Good afternoon, everyone, and thank you, Bill. Our presenters, as you can see, are on camera today in the media player on the left side of your screen. There's a Q&A widget just under that, so feel free to enter any questions you may have, and we'll address them throughout our session today. In the event there's too many questions to get through, we will generate an FAQ document, which we'll send out to you in the coming weeks. Today's presentation is available in the resource widget for downloading on the right side of your screen, just under the bio section of our illustrious speakers. The presentation will be available in French for download in the next few days. As you can see, each area within the platform is responsive, so you can maximize or minimize each box based on your viewing needs. Our slide presentation will show in the middle of your screen, and as well, the session is being recorded today, and you will receive the on-demand link via email tomorrow. We have a short survey we'd ask you to fill out, and it will automatically pop up at the end of the webinar. You can access it by clicking on the survey icon at the bottom of your screen as well. And to the right of that survey icon is a Contact Us button. Feel free to send us an email if you'd like any further information on what we've chatted about today. Now, before we dive into today's presentation, we'd like to ask a polling question to find out where you, the audience, are watching, waiting, listening to from Canada today. So we'll keep this up for a couple of seconds, either the city that you're joining us from or that you're closest to. And let's just get some results showing up. We'll just kind of click back here. And look at that, almost 70% of our audience today is in the balmy 29-degree plus humidity area of Toronto. So Bill, over to you and Benny.
Thanks, Sandra. Now, based on some of the data we'll look at today, those people saying Toronto may be in Tillsonburg or Woodstock, but Toronto is a much bigger place than it was 17 months ago. And so we're really delighted today to talk about sort of where things are going from a Canadian housing perspective and more importantly, in a mortgage perspective. Kind of where do we see things going? How have things progressed? As much as this has been a major economic disruption, it certainly hasn't behaved the way we've seen disruptions in the past. And so I'm really delighted to have Benny Tal here today, Deputy Chief Economist at CIBC, a frequent commentator on the Canadian economy. My experience, and Benny and I go too far back to give years, but is the fact that he can shed a little bit of fun and light on what is generally referred to as the dismal science. And so, Benny, I'll let you lead the way.
Thank you very much, Bill. Listen, a lot to talk about, and obviously not enough time, only 20, 25 minutes. So I will go through this presentation relatively quickly, and hopefully we'll have time for Q&As or some comments. Very quickly, clearly, we still have to talk about this virus. I know that all of you are tired of hearing about that virus, but unfortunately, that virus is not tired of infecting us. So clearly, we have a situation in which this virus is clearly a factor. We have to discuss the trajectory of the recovery given the tug of war between the virus and the vaccine. So we'll talk about that. We'll talk about the nature of the recovery. We'll talk about the speed of the recovery, and then we'll talk about policy. Who is going to pay down all this debt? What about interest rates, inflation, and of course, what it means for housing and investment? And if we have time, and we'll see if we have time, we'll discuss to what extent COVID-19 is an event or a condition. Let's start very quickly. This chart in front of you is showing and demonstrating how optimistic the market became. We had a situation in which just a few short months ago, the market expected a recovery, but basically to follow the gray line, basically to stay below the level we have seen before the crisis. Now, with vaccination and fiscal policy, the market is becoming so optimistic in the US. So now you follow the red line. Not only is the market expecting to go back very quickly to 2019, but actually to exceed it. This is something that we haven't seen in a long time. This has major implications. Now, where is Canada in this? We, of course, are lagging behind. We are lagging behind for two reasons. One is because we are starting from behind. You see, that's very important to understand if you care about the difference between Canada and the US, the dollar and interest rates. For a given level of infections, since the beginning of this crisis, for a given level of infection, the US economy was about 20 to 25% more open than the Canadian economy. Now, the negative spin for them, of course, was that the infection rate was higher. The positive spin is that economically speaking, they did better. Their unemployment rate did not suffer as much as ours, and their GDP did not go down as much as ours. So that's the story, and that's why we have to run faster in order to stay in the same place. But we are not running faster, are we? We have a situation in which Canada is very generous in terms of fiscal policy. Trudeau is very generous, but nothing compared to Biden. We are talking about $1.9 trillion injection into the US economy, almost all of it in 1 year. That's 10% of the economy. So you have a few things happening. You have opening up, you have vaccination in the US, you have interest rates at record low, and then you have this huge fiscal stimulus enhancing the ability of the economy to grow. That's a lot of lift. And if you generate enough wind, even pigs can fly. And that's exactly what we are seeing in the US economy now, expanding by 10% now as we talk on an annual basis, something that we haven't seen in a long, long time. Again, low interest rates, opening up, and fiscal policy together leading to a significant increase in trajectory of growth in the US. Now, this means clearly that the US will cross the finish line 2-3 quarters ahead of Canada. So we are talking about Canada is lagging behind. However, in absolute terms, Canada is still going to do extremely well in the second half of the year. Now, I know that the timing is tricky because we still have this Delta variant that making everybody nervous. And I totally understand why this is a situation in which we have to be careful about predicting the timing of the recovery. We might have a third wave or fourth wave, actually, in the fall. Nobody knows. But I think that the direction is very clear with the vaccination trajectory in Canada improving on a daily basis. So relative to the US, we are lagging behind. In absolute terms, we are still talking about roughly 7% GDP growth on an annual basis in the second half of the year. This is significant going into 2022. Now, there are a few reasons why I believe Canada will do extremely well in absolute terms. One is the fact that we have learned to live with this virus and function with this virus. You see, this is the economy during the waves. First wave, free fall. Why? Because we had no clue what's happening. We didn't know how to deal with it. It was a shock. So the economy went down dramatically, as you all remember, of course. Second wave was actually worse, medically speaking, but economically speaking, you can see hardly moved. Why? Because we simply learned how to function with the virus. Same goes for the third wave. Listen, we have a situation in which e-commerce was much less available in the first wave, much more available in the second wave, third wave. People are taking risk. Listen, in the first wave, we were in the fog. We didn't know anything. Nobody took any risk. Now, second, third wave, we see the light. We know that there is a vaccine, so companies and individuals are starting to take risks. And then productivity. Listen, we are much more productive. I can find the mute button on Zoom. That automatically makes me 20% more productive. We see it in construction. We see it in manufacturing. Productivity actually is rising relative to the first wave. So simply put, we are able to function with the virus, economically speaking, better than during the dark days of the first wave. In addition, you have the nature of the recession and therefore the nature of the recovery. You see, if you are in aviation, restaurants, hospitality, you feel the pain very deeply. But the number of industries that really feel the pain significantly is relatively small compared to any other recession. So the damage is very, very deep, but also very narrow. This means that when we are on the other side of this madness, it will not take much in terms of the number of industries involved to reach the promised land again. So the speed of the recovery will be relatively fast. That's number one. Number two is the flexibility of the service sector. You see, all the damage, not some, all the damage that we are seeing now in the economy is in the service sector. The goods sector is doing fine. Why? Because you press a button and you get your exercise bike, no issue whatsoever. So everything is services. That's the bad news. The good news is the service sector is much more flexible than the goods sector, which means that the trajectory of the recovery will be much faster. After all, it is much easier to start a new restaurant than to establish a new manufacturing facility. So I believe that, again, the speed of the recovery will be very, very rapid relative to any other recession. So we have two factors here. One, the deep and narrow factor. The other is the flexibility of the service sector. But the most important factor is the cash factor. We know the story. This has been by far the most asymmetrical recession ever in Canadian history. All the jobs, not some, all the jobs that were lost were in low-paying occupations. In fact, high-paying jobs, their number went up by 350,000 jobs. So we have a situation in which mid to high-income individuals, their job was there. Their money was there, their income was there, but their spending went down by 30 to 35%. So you spend less and you make the same or even more. All of a sudden, your checking account is becoming heavier and heavier. We wake up in the morning and we realize that Canadians are sitting on no less than $100 billion of excess cash, sitting there collecting 0% interest, looking for direction, waiting. I had a conversation with our finance minister, and she asked, what can we do to convince those people to spend that money? And I said, provide the vaccine and get out of the way. They don't need any motivation. They are motivated enough. So that's the story. And this money, the minute we have the green light, and this green light is getting closer and closer, as we all know, some of this money will be spent. And the good news, it will be spent where? On services. Exactly where you need the jobs, exactly where you need the investment, where the pain is, where the damage is. So that's the story regarding individuals. And if individuals are sitting on a mountain of cash, businesses are sitting on more cash. Roughly $130 billion of excess cash, again, looking for direction. Together, we have $230 billion of excess cash that will be spent one way or another supporting the economy in the second half of the year and into 2022. So that's a story. It's a very good story. It's a good news story. And I think that it will materialize one way or another. The timing is still tricky given the Delta variant, but it's coming. However, there is always another side to the story, namely the no free lunch side of the story. Here we are talking about government debt, for example. We all know the story. We know that the debt to GDP number went up from 30% to 50%. We know that the budget deficit is approaching what? Close to $400 billion. The debt level is about $1.2 trillion. We know the story. The question is, who is going to pay that debt? And the short answer is nobody. Nobody. You see, governments don't pay down debt. They roll it over. As you can see from this chart, we never pay down debt. Margaret Thatcher in the 1980s said that governments, they are like families. They have to balance their books. They have to pay down their debt. No, no, no. Governments are not families because families don't have the Bank of Canada. So what the government is doing is simply rolling it over and refinancing. The debt to GDP ratio went up from 30% to 50%. Interest payments on the debt went down by $4 billion because of refinancing. So the story here is that the government, Ottawa, is becoming much more sensitive to the risk of higher interest rates. That's very, very important to understand. And then, of course, you have another factor, which I think is more important, and that's the chart to the left. That's government spending as a share of GDP. And I believe that we are in the midst of a permanent increase in government spending. You see, before the crisis, government spending as a share of the economy was about, 15%. Now it's about 35%, crazy, it will go down. But when it goes down, it will stabilize at, let's say, 18, 19%. And this level will reflect a permanent increase in government spending. You see, without even noticing that, we are putting together the infrastructure, the plumbing for tomorrow's social assistance programs. We have the national daycare system. That's $30 billion over 5 years, and then about $3 to $4 billion a year after that. That's a permanent increase in spending. We are talking about modifying the EI system. That's a permanent increase in spending. The question is who is going to pay for it? The answer is all of us. I believe that eventually, and this eventually is maybe after the elections, we might see some increase in taxation. We see Biden trying to introduce a $3.1 trillion tax package. He will not get it, but he will get some. The UK just raised corporate taxes. And Canada will do something. Maybe it will be a higher inclusion rate on a capital gain tax. Maybe it will be something on dividends, on options. Maybe you will take a carbon tax money and bring it to general purposes. And if they are desperate, they will go after GST. 1% increase in GST will give you $7 billion like that. Again, I'm not predicting, I don't know, but I think it's reasonable to assume that this permanent increase in government spending will be met with some increase in taxes. That's the chart to the left. The chart to the right is the Bank of Canada, which is the other side of the equation. We all know the story. The government is issuing bonds to pay for all those goodies, and the Bank of Canada is buying bonds from the secondary market to remove them from the market. And all of a sudden, and if you update this chart, you will see that actually already the Bank of Canada controls no less than 40% of the bond market, on its way to 50%. The only country that is even close is Japan, and the question is to what extent all of us are turning Japanese. And the answer is probably no, because the Bank of Canada is now toying with the idea of slowing down quantitative easing, namely the amount at which it is buying bonds, with significant implications for the bond market and interest rates. We started with $5 billion a week. We went down to 4 to 3, on its way to 1 when it's neutral. I think that's the direction we are going, and that's very, very important in terms of interest rates and mortgage rates. Of course, this has implications, because when you print money, something can happen, and this something is inflation. Now, if you are under the age of 30, you are probably unfamiliar with this word, inflation, because it was missing in action. Just to be sure, I checked in the Oxford Dictionary. Inflation is still a word in the English language. Should we lose sleep over inflation? Clearly, there is a reason to be concerned. Money supply is rising like there is no tomorrow at about 20-25%. You go to Economics 101, and they will tell you that when money supply goes up, you have inflation. Not only inflation, you have hyperinflation. But if you look at the footnotes of Economics 101 of this page, you will find that in order to see inflation, you need not only money supply, but also you need to see the velocity of money rising, the speed at which money is exchanging hands. And this speed, until recently, was in the basement because nobody was doing anything. Now, all of a sudden, we are opening up, and all this mountain of cash is starting to be utilized, which means that the velocity of money will start rising. When you have too much liquidity and velocity rising, you have inflation. And the trick now is this tug of war between the bond market and the Fed and the Bank of Canada. Can you remove liquidity from the market quickly enough before you see inflation? So let me start by saying that the narrative, as far as the Bank of Canada is concerned, is that inflation that we are seeing now, and we're starting to see inflation, 5% in the US, 3.6% in Canada. And this increase in inflation, most of it is what we call the base effect, the year over year, because that's the way you measure inflation. And remember, a year ago, nothing happened. So prices were very low. Now we are improving, so they are rising. So on a year over year basis, when you start from a low base, you have a jump. We call it the base effect, not a big deal. The question is to what extent you have more inflation beyond the base effect. So let me tell you something. Nobody knows where inflation will be 6 or 12 months from now. Nobody. And when I say nobody, I include the Bank of Canada and the Fed in that nobody. Nobody knows. And that's something that we have to recognize. There is a risk that inflation will be a bit higher than expected, because the narrative from the Bank of Canada and the Fed is that, yes, it's rising, but it will be short-lived. Maybe, but nobody knows. And we have some other inflationary forces. For example, and that's very interesting, we see wages are rising at the low end of the occupation scale. Why? That's very interesting. If you want to see where Canada will be a few months from now, what you need to look is at the US and Israel, for example, two countries that are ahead of us in terms of vaccination and opening up. And what you see is something fascinating. As long as government support is there, and it's still there in the US and Israel, people don't go back to work. They simply decide to stay home, especially low-paying jobs, like restaurants, like hospitality, exactly where you need the jobs. So you can see that the job vacancy numbers in places like the US and Israel are rising, and therefore wages are rising in order to attract them. As long as you have government support, you don't have people going back to work the way they could have. And that's something that, at least in the short term, is inflationary. Another factor, of course, is the supply chain issue that you are all familiar with. We have major delays, and therefore prices are rising. Commodity prices are rising. We all know the story, reflecting opening up globally. And there is one more thing happening. The consumer is less price sensitive. Believe me, when you can go and get your haircut, you will not start bargaining on if the haircut costs $2 or $3 more than before, because you have the cash to pay for it. You have accumulated this $100 billion of extra cash. So the consumer is less price sensitive. So whatever increase in prices can be transferred to the consumer and not impact profit margins the way it was in the past. So that's another inflationary force. Why is it so important? Because inflation is a lagging indicator. Inflation is like this brown spot on the banana. By the time you see it, it's way too late. And if you're the Bank of Canada or the Fed, the last thing you want to do is to wait for too long. Because if you wait for too long, you chase a lagging indicator. And when you do that, you panic and you raise interest rates way too quickly. The number one risk facing the Canadian housing market is a rapid increase in interest rates. I don't think it will happen. In fact, I think that the fact that the Bank of Canada is telling us now that they are going to move probably in mid or late 2022 is a very good thing. You don't want to wait and wait and wait and wait and then start chasing this lagging indicator and raise and overshoot with interest rates. If you look at what happened in 2008, before 2008, Greenspan raised interest rates from 1.25 to 5% over the course of breakfast. Now, it was not the cause of the crisis, but it triggered it. Every economic recession was helped, if not triggered, by a monetary policy error of overshooting. So the earlier the Bank of Canada and the Fed start raising interest rates, the better it is. Now we have a situation in which the market is expecting the Bank of Canada to move earlier than the Fed and in a more aggressive way. I don't think it will happen. I think that the Fed, that is still talking about 2023, 2024, will move much sooner. And both central banks will start moving in the second half of 2022. I think that will be a very good thing. Why? Because as a society, we are much more sensitive to the risk of higher interest rates. Every basis point counts. This chart to the right is a measure of that sensitivity. And I estimate that raising interest rates by 1% now is equivalent to raising interest rates by 2% basically a decade ago. We have to recognize that the situation is very different. Every basis point counts. And when interest rates start rising, the Bank of Canada will be much more powerful given the increased sensitivity to interest rates. And that's the motivation for this seminar and the paper that CIBC and Equifax will be writing together and release maybe next week, the sensitivity of households, the mortgage market, to higher interest rates. And if the Fed and the Bank of Canada move early but slowly, that would be a much better outcome than the wait and then raise interest rates in a panic. This, of course, has implications for the housing market. We all know that the housing market has been on fire. And I will not get too much into it, but the reason why it was on fire, it was not just because of low interest rates, but because of the fact that more people were able to take advantage of low interest rates. You see what I mean by that? Going back to the asymmetrical nature of this recession, most of the jobs, actually all the jobs lost, were young people and renters. Most of the jobs lost because they were in low-paying occupations. They are not in the housing market. At the same time, the share of people that were untouched by this crisis financially was at a record high, mid to high income individuals. This means, and that's crucial to understanding the housing market, this means that home buyers were able to benefit or to take advantage of the benefits of a recession vis-a-vis low interest rates without the cost of a recession vis-a-vis a broadly based increase in the unemployment rate. And that's the secret behind the huge recovery in the housing market. We know that the housing market is starting to slow down for two reasons. One is that we are reaching a resistance level when it comes to prices in the low-rise segment of the market, simply too expensive. Second, until recently, we have been borrowing activity from the future because there was this sense of urgency to get into the market, and maybe the future has arrived. This chart is basically a reflection of the trajectory that we have seen during COVID, in which people were driving until they qualified 2-3 hours from Toronto. Why? Because they can work from home. That led to this trajectory in which prices rose in line with distance. This was a trend that started before and was accelerated during COVID. I believe that it's unsustainable. I think it will stabilize, and in fact, it might reverse a little bit because I believe that cities will be back. The whole business of people working from home is great, but it's not going to be 100%. We know that many people want to have this kind of mixed model, working from home and working from the office half a day or a few days a week. But you can see that many CEOs are telling their people, we want you back. Maybe not 100%, but a few days a week. So if you have a house 2 or 3 hours from Toronto, you might have a problem if you have to go back to the office. And if your current employer is okay with you working from home, what about your next one? So it will have an impact on job mobility, if you wish. So it's very complex. Overall, I believe that the office will be back, but I believe that Class A office will do fine. Class B and C will not do as great, because that's where I see vacancy rates rising. The last point that I will make in the next 2 minutes is to what extent COVID-19 is an event or a condition. Clearly, when it comes to e-commerce, e-health, e-education, significant changes, and that will be lasting impact. And therefore, in this sense, it's a condition. But economically speaking, namely the speed limit of the economy, the ability of the economy to grow, I still believe that COVID-19 is an event, not a condition. We haven't lost our production capacity. We haven't lost our ability to shop. We just are waiting for this green light, and it's coming. So yes, The global economy is being transformed. But when the fog clears, everything will look very, very familiar. I will stop here. Thank you very much for your attention. Bill, back to you.
Thanks, Benny. We do have a couple of questions from the group. I'm going to ask one, and we will capture the others and send them out later. But the question I thought was interesting was, what about the dollar? We're kind of up at a little bit below the 82 cents right now. Do you see the dollar as something that's concerning that may slow down our recovery?
Yes, absolutely. The dollar is an issue. The dollar has no business being at 82 cents. I think it's too expensive. There are two reasons for it. One is commodity prices, and that's a good thing. The other, which is not such a good thing, is that the market is expecting the Bank of Canada and the Fed to move, the Bank of Canada to move ahead of the Fed, as I indicated earlier. And that's about 30% of the recent increase in the value of the dollar. To the extent that the market will start realizing that the Fed will be moving much earlier, that will change this dynamic. So our forecast, and again, you cannot forecast currencies, let's face it, currencies have their own mind. But to the extent that you want to focus it, commodity prices probably will remain stable, will remain elevated but stable, and this gap between the Bank of Canada and the Fed will be erased to an extent, and therefore I believe that there is a reason to believe that over the next year, the dollar might be going down by a few cents. We hope so. Clearly, the Bank of Canada will welcome that.
Great. Thanks, Benny. So before we move on to the next section, just a really quick poll. So Benny talked about return to office. I'm sure many of you are having conversations. So the question really is who's looking forward to going back to the office at some point this year? So interesting. It certainly is a good mix of feedback. I know we hear from some people who can't wait to get back to some kind of normal and kind of into their workspace. And many others, as I'm sure you're all hearing at your offices, really have gotten comfortable and feel very productive at home. So it is a really interesting component as we kind of think through where the market's going and what does it really mean from a mortgage and a housing perspective. Benny really talked about sort of this nature of this recession, and it has been massive by historical levels. And so you kind of see this big shift there. But to Benny's point, a small portion of the economy was significantly impacted, and lots of people weren't. And so there really has been this ingredient for a relatively strong market, particularly for housing, that's been supported by a number of different aspects kind of within the marketplace. One of those is this disconnect between historical recessions and the way that credit performs. And so if you think back to the financial crisis, you can very clearly see that, as unemployment went up, delinquency went up. I remember as a risk manager at the time, I remember having to fill out template after template because there was a very close connection, probably with about a 1/4 lag, but it was a very clear connection. We've seen none of that in this period. So, government support, deferrals, and just the fact that in many cases, people had more savings out there was helping them actually make their payments. And so even when we saw the deferrals last summer, we still saw a lot of people get a deferral and continue to pay. It was really just a safety net. And so we've seen this breakdown between delinquency and bankruptcy and just the unemployment rate in the recession. And so you started to see this behavior that was very different than anything we had seen historically in a recessionary period. The other part that was really different is just the behavior of non-mortgage debt. So we'll talk about mortgage, and we really know what's happened from a housing perspective. But on the non-mortgage side, credit cards, car loans, all of those things are down fairly significantly over the last 18 months. And so we started to see people change their behavior. Benny talked about it and showed that first wave, just this colossal drop in economic activity. Not surprising, that's going to affect car sales, it's going to affect credit cards. So a lot of those things really were impacted last summer, but started to recover, by the fall. And credit card spending, for example, was back to pretty much pre-COVID levels in the fall. And so this was no longer about people just not using credit anymore. It really came back to those government support programs that were really helping drive disposable income and people's savings. And so they were actually paying more. So even though spending got back to normal levels, the payment on credit cards actually remained much more high, much more elevated. And so credit card balances right now are really back to sort of 2015, 2016 levels, something we haven't seen in years in a marketplace that was showing kind of a 4 or 5% annual growth rate. So we've seen this really quick retraction, and we've seen that in a couple of different products. You know, lines of credit, again, a revolving credit program or product that you can really do these pay downs. And so we started to see this sort of really quick pay down in non-mortgage debt that freed people up actually to take on some of the mortgage debt that they started to accumulate. When we look at debt to income, which has really been this sort of misused benchmark of our kind of financial health, we're now back down to 2015 levels, really driven off the fact that it's the disposable income growth that's really driven that recovery. You know, credit continued to grow a little bit thanks to mortgages, but just the fact that the disposable income grew so much quicker really got our sort of payment debt to income ratio back down, and even took debt service ratio levels back to sort of more normalized levels. They were escalating towards the beginning of the pre-COVID period, and so we were starting to watch that a little bit more closely. But again, that income growth and that government support in particular has really helped underpin the marketplace. And so what that's really meant is that, you know, we've talked about economic lockdowns and all of these things that have happened. That has certainly not been the case from a Canadian housing perspective. And so when we look at it from the mortgage side of things, we really have seen very strong growth over the last year. You know, we saw the big strong dip, you know, kind of through May of last year, and then a really strong recovery both in the activity levels and then a really strong increase in actually the average mortgage balances that people were taking on. So you started to see that shift fairly early last year. It's continued and accelerated in many regards in the first quarter of this year. And one of the things we'll touch on is it's no longer the traditional markets. When we used to do these kind of charts, we would look at Toronto, we would look at Vancouver, because those were the markets you were really seeing kind of much more elevated mortgage levels. But we're starting to see that in places like London, Hamilton. And so you started to see a really strong acceleration in these sort of what we would call far suburban markets as people started to shift out. And so that really has been a key driver in terms of the marketplace. And so when we looked at housing, we really look at three sort of core underlying micro trends that have really been driving the activity. Benny talked about interest rates, so they're unquestionably the primary driver here. And what we've seen is certain markets that weren't performing particularly well pre-COVID have actually rebounded fairly strong. So places like Calgary, Edmonton, Regina, even Vancouver, where activity and house price increases had really slowed down, started to come back because lower interest rates were just driving people into the marketplace. Then we've seen what Benny talked about was this notion of remote work and people moving further away from the city, getting more property, you know, for the same kind of dollar. And so we've seen places like Woodstock, Tillsonburg, London really see much quicker price acceleration there. And then the third one is, you know, and I know a few people personally who've done this. Without travel, people were looking for alternatives, and one of those alternatives was cottage. And so we've seen the cottage market, particularly Ontario, really start to escalate, but even in sort of the interior of BC as well, places like Chilliwack, we really started to see a lot of price increase. And so if you see those sort of key drivers, some of those being relatively temporary, are sort of the marketplaces where we expect to start to see a little bit of pullback quicker than overall. So what was really driving this underlying activity? And so interest rates was one important part. And one of the things, and Benny touched a little bit upon it, is we also think this really meant taking some future activity and future demand and bringing it today, so that particularly in the first-time homebuyer market, they were taking advantage of these really, really low, historically low interest rates. And so what we've seen is a very strong increase in first-time homebuyer activity. What we thought was a really interesting trend, though, is in the first quarter of this year, we saw a little bit of a pivot. So first-time homebuyer growth still remained very strong, but we actually saw existing homeowners who were starting to take on new mortgages as well and new properties. So we started to see a broader recovery in the last quarter for sure, but that notion of first-time homebuyers has been really critical. They're the ones most sensitive to interest rates. You know, they've had this, you know, excess savings that Benny talked about. He showed that sort of the personal deposits chart. People have had money in the bank that they don't normally have, which has really helped with down payments. And so that allowed people to get into this marketplace a lot quicker, but it also means it's borrowed some future activity. That might be offset a little bit by immigration as we sort of restart that engine, but it will potentially have a little bit of a lag where we'll see the market slow down a little bit because you've seen this shift from future to today just to take advantage of those marketplaces. And really, when you reflect on whether or not it's interest rates, I mean, I think the key for us, particularly with first-time home buyers, has just been their ability to increase the amount of mortgage that they're buying, but not necessarily their payment. And so when we look at that chart on the left-hand side, what you've really seen here is a massive increase in the mortgage amount that people have taken on. You know, if you look at Q1 of this year, it's almost 19% increase in the average mortgage for a first-time home buyer, but the monthly payment's only up about 3.5%. And so that ability to lock in at these low interest rates has really, really driven that demand, because again, you want to get that low payment as quickly as you can. And so if you can get the down payment, you are going to come into the market sooner. The one thing that we are watching is a little bit of a concern from our perspective is where we've seen fairly significant increase in the mortgage amounts are actually tied to some neighborhoods that typically have lower income. And so as comes time for renewal, those who've used a variable rate may start to feel pressure as interest rates start to go up. You know, 3 to 5 years from now, as you renew, we would expect interest rates to be potentially significantly higher than today. And so if that marketplace hasn't moved up from an income perspective, you start to see some of those constraints longer term from their ability to pay. The one thing that we've been tracking, and it takes a little bit of an explanation, but what we've done is we've used our credit data and we've said, hey, where I can find it where it looks like parents and a child live together and that child has left and now bought a home, we wanted to understand this notion of gifting. And so we've read about it, you know, anecdotally. You've heard about, you know, parents giving, you know, their children $100,000 to help towards a down payment. We're hearing more and more people using personal guarantors, so that helping their children by putting their own guarantee against their mortgage. So we've seen this notion of gifting growing. And what we've really seen more recently is, are those parents that we could identify actually using their own personal credit to help their children get into the market sooner? And so what we have seen is a significant increase from 2019 to 2020. So we did see, as we went into this COVID period, as these first-time homebuyers were coming to market, probably moving forward with their purchase, we've seen parents leveraging things like their own home equity lines of credit or taking out a personal loan. We didn't look at things like car loans or credit cards. This was really, did the parent use $50,000 more in credit? And what was really interesting, if you look at a market like Toronto, where it was relatively flat, it's because it was a pretty common thing that had been happening. And, you know, it's when you went to other markets that were typically very, very low rates where you started to see more sizable increases. So again, the Calgary, where the market was relatively soft going into COVID, again, parents kind of helping their children get in there quicker to get really take advantage of these really low interest rates. And so that's where we really started to see this difference of this increasing notion of, hey, I'll help you with my home equity line or a loan that you then pay me back that gets you in a marketplace. So it just to us was another indication that we probably did see that notion of moving that purchase earlier to really take advantage, especially when we saw the bond market start to go up, you know, sort of tail end of last year, earlier this year, and some of those mortgage rates started to rise. You started to see more of this behavior. As I mentioned, one of the interesting trends we've seen more recently, particularly in the last 3 or 4 months, has been an increase in people who are already homeowners. So either upsizing or downsizing, but really taking advantage of this price appreciation. So the early movement was very much interest rate driven and really heavily skewed towards first-time home buyers. But more recently, we're starting to see people who are actually taking advantage of the market and trying to help. So the question from a poll perspective, has anyone in this crowd actually taken the opportunity to either upsize, downsize, as they kind of move through this very rich marketplace? So interesting that we did see a bit more on the upsize, which again is something that we did see from our data perspective. So it really does kind of look at, you know, that opportunity again with lower interest rates, good strong house prices for the home you were selling, really providing some home equity to make those moves up. And so we saw 2 interesting trends with these existing buyers. And so the slide on the left really looks at, you know, our mortgage data and what we consider a new mortgage. Quite often it would be, you know, someone who's either refinancing or renewing, gone to a new institution. But we have seen a more significant portion of what we've been seeing over the last year has really been people who actually got a new mortgage and a new address. So we know that those are people who use that mortgage to actually move. The one other interesting thing we started to see, again, particularly with these existing homeowners, is more inter-province movement. So people who are kind of leaving one province in for another. And so you started to see changes in behavior. A little bit of that, again, I don't need to be local anymore. I can move further away. And so you started to see this change in behavior in terms of even the nature of how home buying was happening and kind of the reasons that people were making that decision to leave. And so one of the things that really jumps to mind, and again, from my perspective, you know, my first job was a housing economist right after the housing boom, the housing bust in the late 80s here in Ontario, that was driven by a lot of speculation. So when you see this really rapid increase in prices, you start to think, how much are we seeing from a pure speculative nature? And we're not really seeing, at least in the last year, a lot of that flipping behavior. So the chart on the left is leveraging data that we have through our partnership with Terranet. But if you kind of look at those gray bars, which are someone who's only had the house less than 3 years and is reselling, their price hasn't really appreciated year over year. Whereas someone who's had that house a longer time has been seeing a bigger gap as they've resold. And so that notion of flipping, really, the incentive to do that was going away. And the chart on the right really looks at the time between, you know, the last purchase and the new purchase. And what you've seen is a shift away from kind of very short term, less than 3 years. That group has been getting more and more narrow. And so the good news is these house price increases are not being driven just by people getting in, flipping their house in 6 or 12 months. This is really about people leveraging what's happening in the marketplace to really drive what is, you know, from an economics perspective, a rational decision in terms of being able to take advantage of that. And so when we look at that marketplace and sort of the drivers behind what was happening, what we did see, again, for younger people, not surprisingly, most of the behavior was, you know, I sold my home and I upsized it for sure. But when you're looking at sort of the 55 plus group, you know, roughly 40 to 45% of that group was actually using it to downsize. And so taking advantage of the fact that they can get a lot bigger bang for their buck today on their current home and using that to pay into a smaller place where they can reduce their debt, reduce their monthly payments. And so when we kind of look at the right-hand, sort of the middle chart there, you start to see that, again, there's this advantage of I can take on a bigger mortgage, and I can do that without really taking on the same degree of increase in my payments. And so people really, again, taking advantage of this interest rate environment that won't last forever, and taking advantage of that. We're on, you know, again, the older people who sold their homes, again, use this as a great time to actually start to pay down their debt. So, you know, I've been able to grow my savings faster than I have before. And now on top of that, I can start to sort of use my property to downsize and improve my payments. And so you're really starting to see a really strong behavior there that, again, is really showing that this is not a market that's being driven primarily off of irrational speculation around prices, but really about, you know, how, lifestyle needs and opportunities. The one thing that we are looking at, there are a couple of dynamics underneath the market that are important to understand. And so when you think of a market like Toronto, we've definitely seen a migration out into Hamilton and Grimsby, Niagara. And so you've seen that natural progression, you know, more property, less dollars. I don't need to be in the city as much. I'll have more flexible work options where I only have to be in a couple of days a week, versus a market like Fort McMurray, which is much more of a structural change. And so people are leaving there. They're not leaving for others, you know, other provinces as much as they're looking for areas. And now they won't be living in the Fort Mac area. If they're working in the oil sands, they'll come in temporarily and leave. So there's a marketplace that likely doesn't sustain and recover itself the same way something like Toronto may, as people, again, to Benny's point, may start coming back into the city, particularly as we start to drive up immigration again. You know, once our travel restrictions are lifted and we get back to sort of 350, 400, 500,000 new immigrants, you will again start to see markets like Toronto sort of get back in there, particularly at the lower end with condos and smaller properties, will really start to improve because it's not a structural change. Again, it's people leveraging what's available to them in the marketplace. So I think from our perspective, and Benny really nailed this conversation, it's really about interest rates and where are they going to go and how sensitive has the marketplace become. So that chart that Benny showed sort of about if 100 basis point increase in interest rates, what would happen, is really something that even in 2017, 2018, we already started to see the really high levels of sensitivity that sit with interest rates right now. And so the left-hand chart, for example, looks at people's ability to pay their credit card in full. And so what we saw in 2017 as interest rates started to go up, we very quickly saw a big drop in the percentage of people who could pay off their credit card in full. That to us is a really good indicator of cash flow. So it tells us whether they're starting to see cash flow constraints or there's concerns of that. And the one thing that really jumped out from a trend perspective is when we broke that down at the WHO, when we looked at people with home equity lines of credit that have a balance of $50,000 or more, that's where we saw A, the most significant drop, and B, the most sustained drop. And so you could see, even with a relatively mild increase in the interest rates, we very quickly saw a change in behavior. So if I had a home equity line with $50,000 on it, typically prior to interest rates going up, I was significantly more likely than the general population to pay off my credit card in full every single month. When we looked at that after the interest rates, not only did they get back down to the general population, they were below and they were sustained below the general population. So you saw that immediate impact on their cash flow that I now have to pay more against my home equity line of credit means I don't have as much to pay on something like a credit card. And so we saw that behavior. And where that really manifested itself was bankruptcy and delinquency, particularly among more senior borrowers. So 55 plus typically are your general group who use home equity lines. That's where we saw a much more sustained increase in bankruptcies and consumer proposals. We saw a much more significant increase in delinquency rates. And so very immediately, and this wasn't something that took a year or 18 months, this happened in a relatively quick time period, that those consumers who had sensitivity to interest rates really were very quickly impacted by that. And so as we think going forward, and that's why Benny's notion of the sort of the speed of interest rate increases is a really critical question. If you think about how quickly the bank had to move last summer or last fall or spring, it was very, very quick. Like we kind of went 50 basis points, so it was really, really quick. If we start to see the upside acting very similar, we will see a much more significant and a much more rapid deterioration in things like delinquency and bankruptcy than we've been seeing, primarily due to that sensitivity to the rates. And when we look globally, we do have the advantage of having similar businesses in Australia, New Zealand, the US. And so we've been talking to our different marketplaces. And the one that's probably most similar to Canada is both Australia and New Zealand. Again, massive lockdowns, border shut tight. And so very similar in terms of the government programs that were put in place. And so we've been tracking relative to them. And now it's very, very early days. This is a chart we think in 3 months will be much more valuable for us. But we've started to see a steadier increase in delinquency for mortgages, at least early stage mortgage delinquency in both Australia and New Zealand. They took their government support programs out kind of first quarter, and so it's starting to play through. And so we know as the government programs start to come off is where we will definitely see a very quick turn back up in delinquency and likely get us back to sort of pre-COVID levels, in the next 12 to 18 months. We don't see this skyrocketing well past it unless that interest rate environment really changes. And so we'll continue to sort of track what happens in Australia and New Zealand. We always call them our southern cousins. And so we think it's a really good indicator given how similar we were and how we managed through this pandemic. And so a couple of key things from our perspective, so we do believe delinquencies and bankruptcies will start to increase. One of the things we saw as deferrals ended kind of last fall, September, October, we saw a very quick increase in delinquency, particularly early stage stuff. That washed through very, very quickly. So again, it was often people who were already delinquent prior to deferrals very quickly went back to deferral. And now we're back to, again, a downtrend in delinquencies. We do think as government support programs go away, because they really are supporting the lower income and typically higher risk populations, that we do think we will start to see a relatively strong increase in delinquency and bankruptcy back to where we were likely 18 months ago. And so that trajectory we think will happen pretty quickly. We think from the housing market perspective, it really is about interest rates. And so as long as interest rates stay low, we think demand will stay pretty good. Again, those products that are variable rate, home equity lines, and even variable rate mortgages, again, will be much more sensitive and much riskier kind of in the next 12 to 18 months as interest rates do start to change. But the one thing we do think backstops the housing market to some degree is, again, this regeneration of immigration, which will really help sort of population growth and the need for new households. Benny really talked about this sort of bifurcated sort of economy where we've got the vast majority is in good shape and then a very small minority is really, really, really impacted. We think that continues. So again, we think the higher risk, lower income kind of renter population, again, likely is going to be a bit more challenged. As you think through collections and sort of account management policies, you may want to account for that and tailor your strategies a little bit more similar. And we do think, the last point really is, it is really about micro trends in the housing market. So we do think localized markets that have really, really boomed likely will start to wane a little bit sooner than everyone else's. And so you'll start to see that pulling back. Things like cottage country, things like, some of the farther out suburbs likely start to see price changes or at least leveling off of prices a little bit sooner than some of the urban markets. And again, reversing some of those trends that are very sensitive to the factors that are there today, which again, low interest rates, remote working, and just this need for a new setting, quite frankly, because I'm tired of sitting in my home office. So this was really quick. Again, Benny had mentioned we will be putting out a paper in the next week or so. There will be some great summer reading for everybody, but I know we have a couple of minutes left. So Kathy, I don't know if you have any questions you think we could cover off?
We have lots of questions, Bill. I don't know. A lot of questions about the property values and the bubble of property values. Are there any thoughts around that?
Yes, let me start. I think that the only bubble that we have is a bubble about talking about bubbles. I think that, we have to realize that the people have been talking about this bubble for 20 years now. The issue facing the Canadian housing market is supply. We simply don't have enough supply. And clearly, the increase over the past year is significant, and we might see an adjustment. Prices might go down. I do believe that it was too strong, too quick. But it's not a bubbly situation because we simply don't have enough supply, and the demand is rising and will continue to rise with the number of new immigrants actually rising, non-permanent residents coming back to the market. So overall, I suggest that if you don't deal with the supply issue, if you think that Toronto is unaffordable now, you wait.
Yeah, and I would concur with Benny. I think from our perspective is that we think localized markets may see a little bit of a change. Again, some of those markets that have really accelerated very quickly and not traditionally on that sort of price increase type of thing, you may start to see those correcting a little bit, but again, no kind of crash. But I think the idea that immigration comes back and it comes back with a bit of a fury will really help support household creation and really support a lot of the key markets in Canada.
Here's a question for you. It seemed that the Bank of Canada has limited ability to raise interest rates, as higher interest rates would have a negative impact within the residential mortgage market. Are there potential increases expected in mortgage defaults or renewals?
Let me start with that. I think that clearly you are absolutely right. That's what I was referring to when I was talking about the sensitivity to higher interest rates. In many ways, basically, the disease is also the cure. The increased sensitivity to higher rates will prevent interest rates from rising. And that's why I believe that when you start early and you start slowly, you don't have to raise interest rates as much. But if you wait and wait and wait, you will have to raise interest rates very quickly, and you probably will overshoot. And that's what might have a significant negative impact on housing. So it's a speed at which interest rates will be rising, and that's where you will see defaults. And that's why when I talk to the Bank of Canada, anybody that is willing to listen, I say start early, start baby steps, so you will not shock the system.
Yeah, and I think our perspective is we do think delinquencies start to come back up, particularly as interest rates change. I think the one thing to keep in mind is our delinquency, particularly in mortgages, at ridiculously low levels today. And even pre-COVID, they were very, very low. And so the fact that they've gone down even further. And so we've got a bit of room, but we do expect, particularly with rates going up, variable rate mortgages in particular, I think you will see a lot of sensitivity. And so I think as we start to see all these programs unwind and a little bit back to normal, that then delinquencies start to go up probably later this year and get back to pre-COVID levels relatively quickly. But again, those are still historically pretty strong performances. may have time for one more, Kathy. There's another one.
There's a question here about the future of the housing market in Fort McMurray, that the prices have been declining since the oil crash, but has the pandemic increased risk in that market?
That's a good question. I don't know. I don't follow it so closely. Maybe Bill knows.
Yeah, so like I said, I think one of the trends that we've watched is we've started to see people leaving Fort McMurray. So the one slide that we talked about, sort of the structural change in a market like Fort McMurray, is where you started to sort of see that, again, people leaving, going down to Edmonton or Calgary, and then just commuting up when they need to the oil sands. So I think a lot of that correcting has happened. So the upside is probably not as strong. I don't know that there's a lot of a significant untapped risk yet. Like, I think we probably are where we are, and it may deteriorate a little bit quicker as the support programs go away. But I don't think there's a lot more downside risk from that, from a market perspective.
Can we ask one more question, Bill? In your research with a buildup of savings, are you seeing mortgage balances coming down quicker than their natural amortization timeframe?
So we haven't really. Again, I think people are taking advantage of it. We did see probably this time last year, May timeframe, fairly significant refinancing activity happened. We're not seeing as much of that today, but we did see it pretty quickly. And so we haven't really seen a faster pay down. I said beyond that trend of where we saw some people who sold and downsized their property and mortgages, but we haven't necessarily seen a significant increase in the pay down curves.
Great. Thanks. I'm not sure that we have time for more questions.
Yeah, no, probably not, but we will address these questions. So everyone look for some kind of document over the next week or so that'll answer all the questions that were asked. And again, thank you very much. We know it's a short week and everyone's really, really busy. So we appreciate your time and attention. And again, any way that we can help we're always here. And again, have a great afternoon and thanks for joining.